Welcome to the debate. Welcome to Breaking News to Trading Moves. So imagine watching an asset plummet toward a major multi-year support line. Your finger is hovering right over the sell button.
And your heart rate is just spiking.
Exactly. You have held on for weeks, but the financial drawdown is just too painful to endure. So you panic and hit sell at the exact penny the price taps that line. You feel a brief moment of relief, right?
Sure, for about 30 seconds.
Right, because a minute later the market reverses aggressively and shoots up 10% without you. Why does that happen? Are you just a victim of your own emotions, or were you surgically hunted by a machine?
I mean, that is the exact scenario that drives traders completely crazy. It feels like a targeted attack on your specific portfolio. You sit there staring at the screen asking, how did they know my stop loss was exactly there?
Yeah, and that brings us to the core tension we are debating today. We are breaking down the true nature of support and resistance levels in the market. We want to examine how these zones actually function underneath the surface.
Right.
On one side, there is the perspective that these levels are primarily emotional memory points driven entirely by trader psychology. I take the stance that these zones are created, maintained, and broken by raw human emotions, specifically fear, hope, regret, and pain.
And I come at it from an entirely different angle. I argue these areas are best understood through the cold mechanics of liquidity, trapped positions, and institutional order flow. From my perspective, these are purely mechanical decision clusters. They're dictated by operational execution and algorithmic programming, not by, psychological states.
Well, let's lay out the groundwork for how we view these areas, because advanced traders already know a support level isn't just a perfect horizontal line drawn at $50. Price rarely respects a precise even number.
Right. We all know we should draw zones, not lines.
Exactly. But where we diverge is why the market behaves that way. I view these areas as zones of emotion. When price approaches an area where buyers previously stepped in, it's not bouncing because of a strict mathematical law or some invisible physical barrier. It's reacting to a collective memory.
Wait, collective memory?
Yes, traders remember the fear of losing money in the last drawdown. They hold on to the hope of a bounce. They feel the sharp regret of missing the previous rally from that exact spot. And they experience the visceral pain of holding a losing position.
Uh-huh.
These specific human emotions create memory points on a chart. A support zone is simply an arena where nervous holders are deciding whether they can stomach the pain anymore. And a resistance zone is where trapped buyers from 3 months ago are desperately trying to escape at break-even. It is a psychological battleground.
Yeah, I completely disagree with framing it around memory and feelings. While human emotion obviously exists in the market, trading zones are basically mechanical decision clusters. We have to look at the operational reality of how large orders are actually executed.
Okay.
A support zone isn't some abstract feeling of regret. It's a physical, programmable location on the order book where short sellers have placed limit orders to cover their positions, where stop losses are actively sitting, and where institutional algorithms are aggressively searching for liquidity.
But those orders are placed by humans feeling pressure.
Look, the origin of the order doesn't matter to the matching engine. The execution of those actual orders is what dictates price action. When early longs take profit, or when a trapped buyer finally hits sell, those are distinct, quantifiable market orders matching with limit orders.
Sure, but
The behavior is driven by capital protection, margin requirements, and liquidity hunting. It functions entirely independent of how anyone feels about the price. An algorithm doesn't feel pain. It just executes a buy program when it detects supply.
You're talking about algorithms like they operate in a total vacuum, though. Let's look at how price actually behaves when it reaches these areas, specifically when we get fakeouts and long wicks.
Okay, let's do it.
Since we disagree on what defines the zone, we have to look at what happens when price breaks a level but quickly snaps back. To me, when price overshoots a level, wicks through it, or undercuts it, this is the market processing collective emotion in real time.
How so? I don't see the emotion there.
Well, think about a trader who sees price slip just below a major support zone. They experience an immediate surge of fear, and they hit the panic sell button right at the absolute low. Or they see price push above resistance, they feel that intense fear of missing out, so they chase the breakout right before it fades.
Right.
This erratic price action happens because market participants mistakenly treat a flexible emotional area like a hard wall, and their subsequent panic creates those messy wicks on the chart.
I'm sorry, but I just don't buy that. Framing wicks and undercuts as the processing of collective emotion completely ignores the deliberate calculated liquidity mechanics at play.
Deliberate.
Absolutely. Institutions and large funds know exactly where retail stop losses are clustered. They are clustered right around those exact horizontal lines because risk management textbooks tell people to put them there. If a textbook says to place your stop loss 10 cents below the $50 support line, so they let the price drift or actively push it just below that obvious support line. This triggers all the stop loss orders from retail traders. That wick through a level is an active, calculated search for liquidity to force out those positions and absorb their shares. It has nothing to do with emotional panic on the institutional side. It is a highly engineered mechanical sweep.
Okay, I understand the mechanics of order flow. I know institutions sweep for liquidity. But aren't those stop losses only placed there because of emotional memory?
Not necessarily.
Wait, think of a support zone not as a concrete floor, but as a stretched trampoline. The further the price pushes into it, the more emotional tension builds until it finally snaps back.
A trampoline? Really?
Yes, the institution only finds liquidity below that line because human beings place their stops there out of the fear of financial ruin. The algorithms you are talking about are explicitly programmed to measure human emotional exhaustion. They are coded to know exactly where the pain threshold is, so you cannot separate the mechanics from the psychology. Without the pain of trapped traders, there is no institutional liquidity to hunt.
Listen, don't think of it as a trampoline. Think of it as a wrecking ball hitting a structural load-bearing wall.
Okay,
It is not about how the wall feels. It's about whether the physics of the buying volume can overwhelm the physical supply of shares sitting there. The tension in your trampoline analogy isn't emotional tension. It's financial leverage.
but leverage amplifies the emotion.
Maybe for the retail guy, but traders place stops below support not strictly because of emotional memory, but because of rigid risk management parameters. A systematic fund places a stop loss just below support because their algorithmic model dictates a maximum drawdown of 1% per trade. There is absolutely zero emotion involved in that placement.
I mean,
The snapback in price is just the mechanical void of supply once that stop-loss sweep is complete. Once the resting sell orders are absorbed by the institutional buyer, any tiny amount of buying pressure forces the price back up because the sellers are completely gone. The pain you describe is certainly experienced by the retail trader staring at their screen, but the market movement itself is generated by the clearing of the order book.
Okay, but if it's just mechanical order clearing, like you say, what actually triggers those resting orders to be placed in the first place? They don't just appear out of nowhere.
They come from trading models.
Specific emotions are the direct catalysts for those orders existing. Let's really map this out. Fear appears near support when buyers begin to doubt their original thesis, causing them to hesitate and withhold their buying power. Greed surges near resistance as traders imagine a clean, effortless breakout, prompting them to blindly throw market orders at the ceiling.
Come on, though. You're assigning feelings to mathematical probability models.
No, I'm assigning feelings to the humans who ultimately drive the market. Regret is the primary driver when price returns to a zone where traders missed the last massive rally. They buy aggressively because they regret missing out the first time.
Right, but
And pain, absolute pain, is what forces the final exit of trapped positions, which provides the capitulation volume necessary for a reversal. These exact emotions dictate when and how the liquidity is delivered to the market.
again, I have to reframe those actions mechanically. It is not the feeling of regret that stops a market from falling. It is the physical act of dip buyers stepping in with capital. It is not fear that halts a rally. It is the mechanical reality of short sellers testing weakness and adding supply to the market. Let's talk about volume nodes for a second.
Sure, go ahead.
We are looking at massive clusters of historical trading activity where we know the bulk of shares changed hands. When price approaches a volume node at a resistance zone, you say greed drives the breakout traders to buy.
But the failure of that resistance zone is dictated by early longs automatically taking profit via limit orders and short sellers entering new positions based on those historical volume nodes. The chart simply shows where decisions cluster, regardless of the emotional state of the participants.
But those decisions are inherently emotional.
Not necessarily. A computer algorithm executing a mean reversion strategy at a resistance zone doesn't feel fear or greed. Mean reversion algorithms simply calculate that the price has deviated too far from its historical average and automatically short the asset to bring it back in line.
Right.
Yet that algorithm provides the exact same resistance as a human trader. The market does not care why the order was placed. It only cares that the order exists.
I cannot accept that premise because it treats the market as if it's populated entirely by emotionless machines operating in a vacuum. Even algorithms are programmed by humans who are trying to exploit human behavioral patterns.
They exploit structural inefficiencies.
You say the market doesn't care why the order is placed, but the timing of that order is perfectly synced with peak human anxiety. The algorithms step in exactly when the human trader can no longer bear the pain.
Well, let's talk about how this translates to practical application then, because understanding whether to view these zones through a lens of emotion or mechanics drastically alters how a trader evaluates the chart in real time.
Agreed.
If you are trying to guess who is feeling pain, you introduce a dangerous level of subjectivity into trading. The real edge comes from objective, mechanical observation. A trader shouldn't be asking how someone else feels. They should be looking at observable data.
Wait, understanding the psychology behind the zone is exactly what gives you the edge. Because these are zones of collective emotion, traders must draw broad zones rather than razor-thin lines. You have to give price room to test the area, fake out, and reveal its true intent.
Okay, drawing zones is fine, but
A level should guide your attention, not force an immediate entry. The core questions an advanced trader asks when price enters these zones are inherently psychological. Who is trapped right now? Who is feeling pain? Who is being forced out of their position?
and that is exactly where traders get into trouble. Guessing who is feeling pain is not a reliable trading strategy. You should be looking at the structural data. Is the price accepting below the zone, or is it only dipping into it and immediately retracing? Are the candles closing strongly through the level, or are they leaving long rejection wicks?
Right, the wicks.
Is the trading volume rising as price reaches the area, indicating active order matching, or is it drying up? These data points provide a mechanical, objective invalidation point.
But why do those specific data points invalidate the thesis? You have to connect the dots for me.
Fine, let me explain the causality here. Think about the mechanics of a limit order book. If sellers are dumping millions of shares, the price drops. But if it hits a zone where an institution has a massive block of resting buy limit orders, the selling pressure hits a brick wall. The volume spikes because the transactions are firing off rapidly, but the price stops falling. If you see a long rejection wick with that massive spike in volume, that tells you mechanically that an institution just aggressively absorbed all the resting supply. They bought the dip, which removes the selling pressure and mechanically forces the price upward. You don't need to assume emotional panic. You simply read the structural data the market provides.
I agree that the structural data is vital, but let me offer a different perspective on how to read those candles.
Okay.
If you strictly wait for the objective data, if you only look at the candle close, you are looking at the aftermath of a battle. The candle close tells you who won, but by then, the optimal entry is often gone. Understanding the emotional pressure building up during the formation of that candle allows a trader to anticipate the outcome.
Anticipating is just another word for guessing.
No, it's reading the narrative of the order flow. If price is grinding into resistance, and you understand that trapped buyers from a previous cycle are finally getting to break even, you know they are feeling the immense relief of escaping without a loss.
Right.
You can anticipate the selling pressure. You know they are taking profit or getting forced out. This psychological read allows you to anticipate the failure before the candle even closes, keeping you out of a late forced entry. You aren't just reacting to a volume spike, you are predicting the volume spike because you know the trapped traders have reached their breaking point.
Anticipating a failure based on assumed emotional pressure often leads to ruin, though. Many traders have assumed the market was experiencing extreme pain or exuberance, only to watch the price slice straight through their broad zone without a second thought. Objective confirmation, actually waiting for the rejection wick or the volume influx, protects capital.
But we both draw zones.
Drawing a zone rather than a line is correct, yes, but we draw a zone because we don't know precisely where the resting liquidity sits in the dark pools or the public order book.
Define dark pools for a second, just so we're clear.
Sure, dark pools are private exchanges where institutions trade massive blocks of shares invisibly, so we literally cannot see the orders until they actually execute. We use flexible zones because institutional execution algorithms randomize their entry points within a cluster to avoid detection. They don't want to leave a footprint.
Right. It has nothing to do with retail traders slowly processing their feelings. A broad zone accounts for mechanical variance in order execution.
Yet, that mechanical variance perfectly mirrors the variance in human reaction times and pain thresholds. Not everyone feels the urge to panic at the exact same cent. Some panic $1 early, some panic $1 late. That is exactly why the zone is broad.
I don't know if I'd say it perfectly mirrors it. Well, as we start to summarize our positions, I maintain that support and resistance are vital tools primarily because they show where trader emotion and memory are likely to concentrate. A precise line merely shows price, whereas a broad zone shows human behavior. The chart remembers where people got excited, where they got trapped, where they were rewarded, and where they were punished. By asking those psychological questions, traders can avoid emotional entries themselves. You look at a chart and see an algorithm hunting liquidity. I look at a chart and see the algorithm hunting the human breaking point.
And to summarize my stance, while human behavior is part of the ecosystem, these zones are far better categorized as structural decision clusters. They map out where stop losses rest, where margin calls trigger, and where institutional liquidity is actively hunted. Emphasizing the mechanical reality over psychology allows a trader to operate on objective data like volume, candle structure, and price acceptance. It frees you from attempting to mind read the collective market, which is honestly an impossible task.
Despite our different lenses, we have reached a clear point of convergence. We both acknowledge that treating a support or resistance level like a perfect, impenetrable wall is a primary cause of poor trading.
Absolutely.
Precise horizontal lines mislead traders, causing them to execute poorly during fakeouts. Traders absolutely must use flexible zones that give the price room to breathe and reveal its structural or emotional intent.
Yes. Whether you view an overshoot as an emotional shakeout or a calculated liquidity run, the practical result is the same. Trading a razor-thin line leads to late breakouts, premature exits, and getting caught in the noise. There is a mutual understanding here that context, strict risk management, and waiting for confirmation are required once price actually enters the zone.
Exactly. Viewing a chart through both a psychological and a mechanical lens provides a much richer understanding of market dynamics. It's not just about where the price is, it's about how it gets there and who is forced to act when it arrives. There is always more to explore regarding how broader market context influences these localized zones.
The mechanics of the order book and the psychology of the participants are intertwined, even if we weigh their importance differently.
Which brings us back to our opening thought. A financial chart isn't a pristine, exact map with binary borders. It's a living, breathing landscape. The boundary isn't a clean line you step over, it's a murky territory filled with hidden traps, resting orders, and collective memory. How you choose to navigate that territory, whether by mapping the mechanics or reading the emotions, is ultimately up to you. Thank you for joining us on this exploration of the market's most critical zones. Keep questioning the lines on your chart.